It's good news coming in for the Indian economy. Rating agencies Moody's yesterday upgraded India outlook to stable from negative. To talk about that and the state of the economy, in conversation with us is the Chief Economic Advisor, Mr. KV Subramanian. So thank you very much for taking your time out and speaking with us today. This is, of course, all thanks to the efforts that you put in. You met with Moody's last week. Does the rating outlook upgrade make you happy, or would you ask for an upgrade for India? You've been pitching for it for a very long time, I do know.
So, Ruchi, I think it certainly is a positive development. The fact that they've recognized that the risks from the financial sector and its impact on the real economy, that has declined, I think is certainly something that is very heartening, because that is indeed a recognition of the ground level changes, the positive changes that have happened. At the same time, our efforts have been to make them see several of the positives that we are ourselves seeing. For instance, just to pick up a particular aspect in their outlook, they've mentioned that 6% is the real growth that they're anticipating in the medium term, which is about 5 to 6 years. Now, there I actually think that if you leave out the last 2 years before the pandemic, which was impacted by the financial sector, the potential growth for India was about 6.5%, and that was without any of the reforms that have been done now. So when you add the impact on investment and efficiency gains that come from all these reforms that have been done, so the potential growth therefore should be north of 6.5%, and yet for them to estimate it at 6%, south of 6.5, is, I think, something that I'm confident will get revised, as has happened itself over the last. So we've been generally, early in calling out these positives. I think they've generally sort of come around from their conservative priors to actually see our points of view. I think this is an illustration of the same thing.
Absolutely. It reaffirms India's stance. Are you taking this issue up with the other rating agencies as well? The fact is that over the last few months, we have undertaken a lot of reforms, and you have been saying that we will see demand pick up. Is this something that you're taking up with the other rating agencies?
Absolutely. This is, but let me clarify that it is part of our ongoing engagement with all the rating agencies, not just the rating agencies, but other international agencies as well, where we have been highlighting to them some of the important differences. To give you a specific example, a lot of them talk about scarring from the pandemic. It is important here to distinguish between the institutional differences between a country like India versus advanced economies. In advanced economies, almost the entire economy is formalized, and therefore, any short-term impact through the financial sector, through balance sheet effects, can create scarring. Now, in the Indian context, you have to actually separate it into the organized sector and the unorganized sector. The organized sector, relies on labor and capital and is very similar to the advanced economy. So there could have been scarring, but there hasn't been. On the unorganized sector, it's primarily their production is dependent a lot more on labor. And so as soon as the negative shock goes away, they come back actually, for almost V-shaped recovery. I think so that distinction is something when one thinks about scarring has to be made, which I've not seen as much, in these assessments by the international agencies. So these are important points that have to be actually taken into account. Understand the intricacies of a phenomenon like scarring, what is the nature of production, and then apply it to a country like India.
Having said that, one of the things that Moody's has said is that the fiscal strength of India is still very weak as compared to peers. Moody's has also said that for an upgrade, India's debt to GDP will have to come down as against the current 89% levels. After the two-wave of pandemic, we did see in the past the NK Singh panel, for example, had recommended 65% debt to GDP, a 3% fiscal deficit target. Do you think perhaps there is a need to revise such targets to align it more with the needs of India?
So, absolutely. I think it is important for the all international agencies, not just the rating agencies, to see the very strong economic arguments backed by data that the Ministry of Finance puts out, has been doing that over the last, entire 2.5, 3 years. For instance, let's take the fiscal situation. Now, while India entered the pandemic actually in a worse situation compared to the peers, if you look at the fiscal deficit, and I'm only focusing on the central government numbers because the state numbers are not there, India at 9.2% fiscal deficit last year compared to 10.5% for our peer economies has done way better, number one. Number two, as we had highlighted in the economic survey, it is the difference between nominal growth and the nominal rate of interest that basically affects the debt to GDP ratio. Even if one goes by, for instance, Moody's assessment themselves of 10% nominal growth, which I think is an underestimate, what you will find is therefore the interest rate growth rate differential will be far, far more supportive for India than any of the other peer economies, because we will grow at much higher rates than peer economies. So I think these are aspects, conceptually involved aspects, that need to be taken into account, to update priors and thereby actually come up with assessments. And that's an effort that we've been trying all through, and some of it is basically fructifying. I think there is a tendency to stick to very conservative priors, but we're trying our best.
I want to understand from you. You are saying that the 6% estimate is, it's an underestimation of sort. You in the economic survey had said that we will close the year by 11.5, at close to 11.5%, 11% growth levels. Are you still going to stick with those projections? Is that where the economy is perhaps headed?
So, if you remember, I also did mention that the budget estimate has taken it at 10.5%. So I, especially given the first quarter numbers that have come and the way the high frequency indicators are moving in the second quarter, I think there's a very high likelihood we will end the year with double-digit growth. And here again, if you look at Moody's, they've actually estimated at 9.3%. I am quite confident that we will actually exceed that, and very likely we will end with double-digit growth.
I also want to understand from you on some of the downside risks. For example, crude prices, which are back at the 2014 levels, hovering at close to $83 per barrel. We've seen trade deficit. In fact, the last few numbers that have come in, close to $22 billion. What kind of risks do you see emanating from the high crude prices, the high commodity prices, because this is really going to pinch the Indian economy?
See, when you look at, and especially you raised about the trade deficit, but, in the last quarter, we've had a current account surplus. And, a current account surplus, which is actually far exceeding what we've had over a long period of time. So, if you look at the, and that is in addition to the, to the additions in the capital account itself. So, overall, I would read the trade, deficit, which is basically imports growing and exports growing, as well. I think as a sign of basically the revival that is happening in the economy. And when you look at the crude prices itself, unlike earlier when the fuel prices were not deregulated, crude prices would have a significant impact on our fiscal deficit. That is not the case now as much, and therefore I do not think that the impact will be as much on them. If you take, for instance, just the GDP identity, the X minus M, C plus I plus G plus X minus M, which is your net exports, there may be some impact of that, but I think when you look at the way investments and consumption are actually growing, and the government is committed to doing capital expenditures that it has budgeted, I don't think the impact should be that large.
Having said that, sir, tax collections have improved significantly. Do you think perhaps there is a case for providing some sort of a relief to consumers in terms of duty cuts that we are seeing, because of high crude prices? Petrol prices are close to 102 rupees per litre in a place like Delhi. So do you believe that the fact that we have good tax collections coming in provides us some sort of a headroom to reduce the excises?
You do have to take into account that we need to do our budgeted capital expenditures. If you remember, in the budget we had actually projected 35% additional, and so both as a percentage of GDP and in just nominal rupee terms, India is spending the maximum on capital expenditures this year, and all that has to be funded for, even from an inflation perspective, which is why we care about the crude oil price or the petrol and diesel prices. If you see over the last few months, as I had predicted, there has been actually moderation in that, and that has come primarily from food inflation. As I've consistently said, in the Indian economy, the retail inflation, which is your head CPI inflation, the contribution of food inflation remains the maximum. I think what we have to keep in mind is there are trade-offs here. When infrastructure is created, when Capex is done, that is indeed something that benefits the common person. Unlike, for instance, let's say the first or what is most obvious from, let's say, a duty cut, the benefits that come from something like this actually is maybe not immediately obvious, but it's far larger and more long-lasting, and that's something we have to keep in mind.
You did speak about Capex. While there has been a big push, on Capex on part of the government, I want to understand from you on your assessment on whether private sector has started putting in money on Capex.
So good that you brought up, Ruchi. If you look at the data again, the third and fourth quarters of last year, the gross fixed capital formation to GDP ratio was about 33% and 34% respectively, and these are both quarters where growth was positive, and there was a good part that was driven by private investment. Of course, government investment actually in Capex contributed significantly as well, but overall in the aggregate economy we did find Capex actually above close to 33-34% when it had been sort of hovering at about 27-28% for a long period. So I think that is something that is a good sign. I think yesterday or day before I was reading that Vedanta, for instance, is planning to do almost like 1.5 lakh crore of Capex over. The duration was not clear, but that's a large amount, about 0.75% of GDP, just one house. Similarly, a few months back, I actually read the Aditya Birla Group is planning to do through the Hindalco. So I think these are all actually clear signs that private investment is actually looking to come in, and that's typically how it happens. Investors see if consumption is picking up and then respond. The fact that if you look at the first quarter numbers, despite a very intense second wave and the lockdowns, not lockdowns but restrictions that had to be placed, which basically affects the supply side of consumption, because even if, let's say, you want to go and buy a shirt or a pant or whatever, right, if the malls are closed, you can't go and do that. So despite that, consumption grew at 20%, and I think businesses are looking at that and saying that the demand clearly is picking up, and therefore this is a good time to invest. So I do anticipate that going forward it should increase.
Are you hopeful of a bumper Diwali ahead then for the Indian economy?
No, I think things are looking good, but I must definitely caution that we all need to follow the necessary precautions. While things are looking good and vaccination has proceeded well, we're still not completely out of the woods. And especially the lesson we need to remember is around March last year, or March this year actually, March of sort of last month of the financial year, we did sort of drop our guard, and then we know the second wave actually came back. So I think caution needs to be followed. We need to follow all the protocols, but I do think that there may be joy for us going forward.
My last question to you, and I want to understand from you on the revenue side, while things are looking good, privatization is yet to pick up. Of course, we're yet to hear on Air India, and though that announcement can be made sometime soon. How do you see the entire privatization process really proceeding? Are we hopeful that we will see BPCL being privatized in this fiscal year itself?
Yes, actually, from what my discussions with Deepam, I do think that privatization, especially the fourth quarter, would be very important in terms of the actual deals happening. Do remember that there's a lot of homework that goes behind from what comes. Basically, it's like I'll give you a parallel. When a high-rise building is being built, when the foundation is laid, nobody gets to see it. The excitement happens only when the first few floors come up above the level of the earth. So it's similarly, actually, the foundation is being laid. You will see some of those floors coming up, and I actually am confident that this year will be a very important year, seminal year for privatization. Do keep in mind that even if, let's say, from a revenue perspective, Air India, may not net in as much, but I think from a signaling perspective and the seriousness of the government to actually implement its enterprise policy, the recent enterprise policy focused on the private sector, I I think Air India privatization is very, very critical, and so the good progress that has happened there is really indicative of the government being very serious on this front.
All right, on that note, I appreciate you taking your time out and speaking with us. So thank you very much.
Thank you very much, Ruchi.